Welcome, everybody. This is Russell Gray, co-host of the Real Estate Guys radio show. And today we're going to do something a little bit different. It's kind of a tutorial, kind of a case study, and it's kind of a boots on the ground interview because we're going to be talking to our good friend, Paul Moore. Hey, Paul, how are you doing?
Hey, great to be here.
And Paul has come up with a way to help people who have accumulated property throughout their entire life, successful real estate investors, hands-on investors that have been trading up and building a lot of equity through 1031 tax deferred exchanges. And if you're an experienced real estate investor, you're very familiar with this. Of course, at some point in your career, as Paul well knows, you get to the point where you're like, hey, you know what? I'm kind of tired of being a hands-on property manager. And the way 1031 tax deferred exchanges work is that you continue to defer paying your capital gains tax, typically until you die. And then when you die, your heirs get to inherit what's called a stepped up basis, and the tax just kind of goes away. And so it's a great tool. But the problem is, if you're that investor, you've got to be a hands-on investor all the way through till the end, till death do you part. So you're married to your real estate. Paul has kind of found a way to allow you to break up without having to pay the tax. And so that's what we're going to be talking about today. And it's through a thing called the Delaware Statutory Trust. So Paul, let's just kind of start with the problem. You know, when I'm out there, and I kind of teased it a little bit, but maybe go into it in a little bit more detail. And I know you've got a case study. We're going to get into that, a real life story where someone failed in a 1031 tax deferred exchange. Mm-hmm. But it really has to do with people wanting to transfer their equity into a syndication. So just kind of describe the problem a little bit from that perspective, if you would.
Yeah, absolutely. So the 1031 exchange is a beautiful thing. And then we thought we might lose it in the 2017 tax law. And a lot of people did. People with airplanes and boats and cars and artwork and collectibles lost the 1031 exchange, but real estate investors kept our 1031 exchange. And we're so happy that we got to do that. But there are a lot of hard things about it. I mean, there's multiple rules and regulations to follow. I mean, you've got to do it right. You can't think later, oh, I should have. No, there's no room for error. The IRS and the folks in Washington are really very clear with this. There's a very tight timeline. I mean, there's 45 days to name one or two or three or more replacement assets for the one that you're selling. And it's a lot harder than it seems because you've got to match the price. So in the dollars, if you're exchanging out of, let's say, $1 million property, if you go into a $500,000 property, you know, it's not the first in, first out thing. It is like you get taxed first, you know, and so there's a lot of matching that goes on. I mean, another thing is, you know, when the seller finds out you're doing a 1031, you lose a lot of negotiating power, especially later if you need to fix something after an inspection. They know your 45 days has passed. It becomes very, very hard. Now, what's crazy about this is COVID has made it kind of harder because it's still a seller's market, yet it's been harder to travel. Some sellers have pulled their properties or not sold them when people thought they would. It's made it even harder in the last several months of 2020.
Yeah. So if you're out there, and of course, I'm sure a lot of people who are interested in even watching something like this are pretty much familiar with 1031 tax deferred exchanges. And, there's a lot of horror stories. And so the people who are kind of, they've accumulated some equity, real estate equity on their balance sheet, and they enjoy the benefits of real estate. But again, they want to kind of get out of the hands-on. And those folks are interested in maybe rolling that equity into what's called a syndication, where you have a professional manager who's either doing a type of deal that would be very difficult for you to do. Maybe you've made all your money in apartments and you decided, hey, that game has run and I'd rather be in mobile homes. But I don't know anything about mobile homes, but that's the space I want to be in. Well, that's where you would go find somebody who knows how to do that really well, and you would roll your equity into their management. In the past, to try to do that, you had to use something called a TIC, a tenant in common ownership structure, because if you didn't have direct ownership, that created problems. So, Paul, you're a syndicator, and talk a little bit about what it's like on being the syndicator, trying to receive TIC money coming in.
Yeah, it's really tough because in some cases, the TIC person will have to qualify for the full loan. So you've got somebody with $1 million, and now they're trying to qualify for a $15 million loan on a $25 million property, for example. So to have them qualify as, sort of an equal partner in the eyes of the TIC rules, that's pretty tough. Secondly, what if they go rogue? I mean, what if they decide, they don't want to sell when it's time to sell? They've got sort of equal voting partner. And you can't change that. You can't, say, well, you don't get a vote. No, tenant in common rules are that everybody gets a vote. And if we had several people like this, one strong-willed person can mess it up for everybody, including all my other, let's say, 150 investors in this deal. And so that is a really, really big risk. And it's hard for the TIC person and the investor, and it's hard for us as syndicators. So it's something we really don't want to do.
Yeah, we did one, and we said, we're never going to do that again. And we had a syndicator student in our program see it as a real opportunity to solve the problem, not at the time being aware of the Delaware Statutory Trust, which we're going to talk about in a minute. And he did a lot of homework and got it all structured. And I think he did one or two and hung it up. He's like, this is just too tough. It makes herding feral cats look easy. I mean, right. just ridiculous. Right. Okay, so, the benefits of syndication are obvious maybe to us, but I think, I'm going to hit a couple, and then if I miss any, you kind of add in some color, because I think people have to understand if they could go to all the trouble to watch this, to try to figure it out, how to do this. The benefit that they're getting, one is they get to retain their equity without paying the capital gains. That's huge. Mm-hmm. They don't have to wait to die. They can keep the 1031 thing going to get out of the niche they're in or the hands-on responsibility. But the benefit of syndication is you can do deals that are too big for you. You can do deals in markets where you don't have a team, you're not familiar, and that can be both a geographic market or a product niche, as I just mentioned. You get professional management, so now you're not the one who has, the buck doesn't stop on your desk anymore. You're a passive investor. You get liability protection because you're in that passive role. Those are kind of the highlights in my mind. Did I miss anything, Paul, that you can think of?
Well, I mean, like you said earlier, it's a chance to get into a different niche that you don't know anything about. If you feel like mobile home park investing would be great, but let's say you're 65, 75 years old and you don't want to learn a whole new asset type. And to that point, you probably might want to enjoy your retirement. And some people would say enjoying retirement would not include managing 200 or 300 mobile home park lots, Or
even managing managers.
Right.
I mean, even that
manager.
Anybody that's built a big portfolio, I have my property managers do everything. Well, I know what that's like, but you're still dealing with the property managers, and you give them limitations, which means when their authority is exceeded, they got to call you and you need to get briefed and make a decision, and you're not relaxed. I mean, it's great when you're doing it, and it's a price we pay to be real estate investors, freedom with responsibility, better than Wall Street, where they just want to put you in a diaper and give you a trading app. Real estate is better, but this syndication can be even better for a lot of reasons. We're huge fans of it, but it's really locked out people who have equity in properties. And so I'm really, really excited about this. So let's kind of get into it a little bit. Talk about how the Delaware Statutory Trust kind of works just at a high level. We don't want to get too far in the weeds because I want to save time for the case studies.
Yeah, so a DST is an ownership model that creates a legal entity which allows sponsors and investors to work together to fractionally own a portfolio or a single property. And it preserves the 1031 exchange. It preserves the capital gains. It preserves the depreciation recapture. In other words, it kicks the can down the road, but the investor has a professional manager. They don't have to manage anything, and they get a pretty predictable, stabilized cash flow. And basically, there's not a lot of upside. It's pretty much a coupon clipping type thing. There's not a huge value add. But investors get the benefit of having someone else manage it for them and they get to keep their 1031 exchange. The pressure to find an asset, gone. The timeline, gone. I mean, the timeline is still there, don't get me wrong, but going out and trying to find a property and negotiate and hoping it works out, all that's gone because it's done for you. And so the elimination of the rogue investor risk with a tick is gone. The size of the property, getting your own debt's gone. You free up your debt capacity to, do something else. You get to diversify into a different asset class. Just tons of benefits with this.
And it's more private.
Yes, that's right.
It's definitely more private. So, if you're out there holding property in your own name and you're rolling things forward, or your name is all over it as the manager, so there's some privacy things. Obviously, when I got started in radio, all of a sudden I became, kind of a personality in this little niche, and privacy became important to me.
Right.
How I held property and where I did things and how I did things all of a sudden became more important, something I'd never thought about before. And you may or may not care about that, but in an internet-enabled world where everybody's in everybody else's business, I think most people should probably pay more attention to privacy than they have in the past. What about the debt side? If I'm a guy that's got, built my portfolio and I've still got a lot of loans and I'm worried about boot, if you're familiar with boot, it means that if you don't carry forward all the equity, or you don't carry forward the same ratio in terms of the amount of debt to the equity, then that is considered a taxable gain called boot, and you have to pay tax on it. When someone's coming forward into one of these things, how do you deal with the debt side of it, or do you?
Yeah, so it's commonly believed that you have to get the same ratio of debt to equity in a 1031. That's not true. It's commonly believed that you have to have at least as much debt and at least as much equity as far as in dollars. That's not true. The total amount of the replacement property has to be higher than, or equal to, or higher than the old one, or the difference you'd have to pay boot. Basically, the difference would be boot, and it would be taxable to you. That's the situation there.
Okay. All right. And then the financial performance of the asset, the trust is a holding structure. So you talked about predictable cash flow, but that was in the context of, obviously the kind of asset class you deal in. But you could really do any type of real estate in a Delaware Statutory Trust if you were pursuing, capital gains and you were going to do a project or whatever, or is it only income producing property?
No, it would be income producing property. It would not be like a development or a steep value add. The DST rules in some way restrict you from doing that type of thing. The type of loan you would get on it, it would be CMBS debt typically, would not.
Commercial mortgage-backed securities.
Correct.
As opposed to agency money.
Right.
Yeah. Okay.
Yep.
All right. Well, let's dive.
To that point, though, I'm sorry, I don't think I answered your question. So you as an individual don't have to get debt anymore. So if you're coming out of a $1 million sale, like I said, and it was 50% debt, 50% equity, well, you can take, your proceeds, whatever they are, and you could put them all into the DST. Then the DST provider gets the debt, and that frees up your debt capacity, and you don't have any debt in your name anymore. And there's also a thing called bankruptcy remote, which means that if somebody gets sued in the group, they can't come after the asset, which they could in a tenant in common, if I'm not mistaken.
Yeah. And again, we're not tax advisors and we're not lawyers, right. So we're giving you ideas and information, but obviously this is something Paul does and is doing successfully and has studied. And so that's why we wanted to bring it, because, I've been doing this a long time, been the co-host of the show for going on, 18 years now. And in all that time, really never talked or heard that much about this Delaware Statutory Trust. And kind of along those lines, Paul, how long has this been a thing? Is this like the newfangled thing, or has this been around and people just haven't been taking advantage of it?
Yeah, so 1031 exchanges started in the early 90s, and then Delaware Statutory Trust came into being just after 2000 or so.
Okay. Now, just for a little context for everybody, most real estate investors are familiar with limited liability companies, LLCs. They kind of hit the scene in the late 90s. I remember it was like 96, 97. And back then it was designed to give you the tax benefits of a pass-through like a general partnership, but the liability shielding of a corporation. And that was what these things were formed to do. In the beginning, nobody wanted to use them because there wasn't that much case law established. But within 10 years, LLCs kind of became the go-to entity of choice for almost every real estate deal that gets done. And so now, if you're saying that Delaware Statutory Trust has been around since 2000, we're talking 20 years of case law. So it's pretty mature in terms of its acceptance in the marketplace. And there's lawyers and tax professionals out there who really know how to do this. Would you agree with that, Paul?
Oh, no, absolutely. Yeah,
okay.
there's companies doing, $1 billion a year. One company is doing in Delaware Statutory Trusts. So it's not like something just hidden in the corner.
Yeah. And I think that's important because, I don't mind being kind of on the dull part of the cutting edge. I'm not a cutting edge or bleeding edge kind of guy. I missed a lot because of Bitcoin and I didn't take advantage of it, because I didn't want to be on the bleeding edge. And if I would have done a risk adjusted analysis, I would have gone, I don't have that much to lose. I could throw $100 at it and see what happens, and I would have made $100 million. But that's water under the bridge. So the point is, though, if you're a relatively conservative investor and you're looking, you're later in life and you've got a bunch of equity and you're looking for cash flow and you want to get debt off your balance sheet and you want a little bit more privacy and simplicity in your life, this is the thing for you to take a look at. And that's why we're talking about it today. So let's get into a case study, Paul. I asked you to prepare a couple and you did, and you're very gracious in doing that. And the first one is, I'm going to call a 1031 exchange gone bad, right? Yeah. So this is what happens when you don't get it right. And sadly, this happens all too often. People hear about a 1031 exchange and they decide to do it kind of spur of the moment. And really, if you're going to do it, you should kind of get together with your advisors and kind of plan your on-ramp and your exit of your property and really start doing your due diligence on markets and building teams so that when you pick properties, you're going to pick ones that you really want to keep and places you want to own them. And you're really prepared to be the owner and all of that stuff. But a lot of people don't get that right. And of course, if they screw the exchange up, it's a big tax bill. And worse, you could end up owning a property where the tax, if you only paid the tax, that would have been a better deal than actually owning this dog of a property that you desperately grabbed because you needed something to save the tax.
Absolutely.
So don't ever let the tax tail wag the good deal dog. So that's gold. I mean, if you've lasted this far into this video, if you don't get anything else from that, boy, take that to the bank. But Paul, tell us a little bit about this 1031 exchange fail.
Yeah. So you guys were on Bigger Pockets, I believe, last year. Well, I do some posting there and somebody contacted me and they said, hey, I'm from right down the road in Harrisonburg, Virginia. And I wondered if you can come have dinner at our house and tell us about what we can do with my dad's situation. So I got to their house and the guy was, I think, 72 years old. His name was George. And George had been running a furniture business all his life. And I think he got out at a good time. It was around 2014 or I think it was 15 or 16 actually. And he was selling it and he said he had $800,000 and all it was almost all gain because everything that could have been depreciated, of course, everything but the land was already depreciated out. So he had this big gain and he was urgent. He was like 25 or 30 days into his 45-day period and trying to find property. And so he said, can I invest in your syndication? And I explained the tenant in common situation. And I said, I just happened to have one coming up. It was a deal it was an apartment complex in Chattanooga. And so I said, look, there's a lot of things that could go wrong with this. And there's so many things. You better go find some other properties. And I strongly advised him to do that. So he went out and found a fourplex and he actually was doing all the numbers on it. And when the 45 days hit, right before the 45 days hit, his son called me and said, bad news. The fourplex was way overpriced. I think they saw us coming. And he decided he didn't want to spend his golden years as a landlord anyway, especially on a property that didn't even cash flow. And so he's trying to decide, does he want to, he doesn't want to pay the capital gains tax. What's happening in your deal in Chattanooga? And I said, well, we just found mold in the due diligence process in 6 of the 11 apartment buildings. And so we pulled the plug on it. Sorry. And of course, day 45 rolled around and he had to pay the tax.
Yeah.
And I just felt so bad for the guy, but that's what happened.
Yeah. And it happens a lot, because again, most investors don't do a lot of 1031 tax deferred exchanges, or some don't. They own a few properties and they built up a lot of capital gains. I mean, this guy probably had his one thing and that was it. Okay, well, so now let's put a happy ending on it. Let's talk about a case study, on a deal that went well. I mean, how does this thing really work in the real world? So kind of give us the tee up a little bit, tell us the story, and then hopefully we'll glean some lessons out of that.
Yeah, so I got a call from a guy named Lonnie, and he was in Lexington, Kentucky, and he was an attorney who was in the process of retiring from a high-powered job. He'd actually done the case, that Covington, Kentucky fire back in the 70s. Remember the country club fire that killed like a couple hundred people? He was a high-powered attorney. He'd made a lot of money. Well, he invested it well. And so Russell, he had invested in a triple net lease, I believe it was, back in the 80s. And he was getting ready to sell it in the early 90s when he heard about this new thing called the 1031 exchange. And so he happily transferred out of that property. He swapped it, if you will, through a 1031 for a medium-sized apartment building. And he actually managed this on the side while he was this high-powered, highly paid attorney. And he told me, he said, it was really hard. He said, I mean, even though I had a manager, he said, I'm dealing with, middle of the night calls. Even though I was only the asset manager owner, I was still dealing with toilets, tenants, and trash. And I really, really hated it. And I vowed never to be a landlord again. So he thought the market, he's a real smart guy, and he saw the top of the market in 2006 and 7, and he sold it. And he actually acquired another situation where he had to be a landlord, but he assumed, I don't mind being a commercial landlord. It's a strip center with, I think it was 8 retail outlets, and the strip center was an anchor, plus, maybe a hair salon, a nail salon, maybe something like stuff like that, a chiropractor. And so he was really happy. And he said, honestly, managing 8 tenants was nowhere near as bad as managing these 20-something apartments. And so as he was thinking about retiring, he realized he didn't want to be a landlord anymore at all. But he sat down with his CPA and he realized there was going to be an enormous tax bill. Okay. So, and he didn't want to do that. He planned to swap till he dropped. So he knew he couldn't invest in a syndication and he couldn't invest in our fund. And he was trying to figure out what to do. Well, around this time, COVID hits, okay? And so now he's got 3 or 4 non-paying tenants out of the 8 tenants. But he had one good thing. He had the anchor tenant who had been practically begging him to buy the strip center for years. So he quickly calls the anchor tenant and he says, hey, if you want to buy, you can still buy. I'm telling you, there's a couple tenants here who are having some trouble paying their rent. I'm sure everything will be fine soon. And it turned out that it was, by the way. But he said, if you still want to buy, here's the price. Well, he got it under contract. Well, that's when he really hit him how hard it was going to be to, basically he had a month and a half plus the 45 days after closing. And he realized it was going to be incredibly hard. COVID made it harder because, remember how hard it was in the early months to travel. Well, he's like, I don't know what to do. So he started going through listings. Right around that time, he retired from his job, and he had this dream of the first month of retirement, all the things he was going to do. He didn't dream that he was going to spend his, 15 hours a day looking at property listings all around the country, frantically calling brokers. I mean, he got so depressed, Russell, after like 2 days of looking at listings. He almost went to see one, and then he just realized this is not how I plan to spend my retirement. And a lot of this is going to require remote landlording anyway. He didn't know what to do. And that's when he discovered the Delaware Statutory Trust. And he actually called me excitedly and he said, hey, there's a few disadvantages to this, but overall, it does what I need it to do. And most importantly for me, it does, number one, it provides a stable source of predictable income. It's not real high. It's like 6%, but not bad.
Yeah, that's like 6 times what you're getting in bonds right now.
Yeah, right. Number two, it provides a hands-off situation for me. I don't have to do any of the work or manage it. Number three, I don't have to spend the next 2 or 3 months going around the country chasing down deals that may never even happen. Number four, it does have some upside. It has about 4% a year appreciation predicted. Nothing huge, but that 6 plus 4 is 10% total annual return. And I'm a direct owner, so I get the tax benefits all along, just as if I owned the property myself. All that accelerated depreciation from cost segregation, all the wonderful tax benefits that happened from late 2017 tax law, all that accrues to me as an owner, but I'm just a fractional owner. He said, in fact, it's like investing in your syndication with just maybe a little bit lower return. And he was just elated. Then he found out what the fees were. And he wasn't super happy about that because there were broker dealer fees and all that kind of stuff. But the good news was the 6% and then the 4, so the 10% total annual return that was projected was actually net of all those fees. So he was actually quite happy with it. He signed up for it, and that was like in the summer. And last time I talked to him, he was actually playing tennis. He said he was breathing hard. I'm like, what's going on? He said, yeah, I'm enjoying a tennis game here by the beach in my condo. And I'm getting I got 2 months of regular checks right now. I am so happy that I did this. And when this 10-year thing runs, I'm going to flip it into another DST if I live that long. And my kids are going to enjoy all this step up in basis. And he was just elated. And so that's the story of Lonnie.
Yeah. So I thank you for sharing that. It's always good to have happy endings. I mean, here's the point. Real estate is arguably one of the best wealth preservers there is, right?
Mm-hmm.
Because it benefits from inflation. You can use leverage, so you can magnify the benefit of inflation. You typically get some of the best tax breaks there are, and the 1031 Tax Deferred Exchange is one of them. The yields are far superior to bonds, and you don't take the same capital risk. Yes, there are some hassles, but that's where syndication comes in. And so if you really understand how to take your real estate investing from being kind of a hands-on mom and pop, managing your own property, and move into where you're a passive investor and you're taking advantage of syndication, professional management, diversifying in niches, diversifying in markets, diversifying in management, isolating yourselves from the day-to-day hassles, and then you use the 1031 Tax Deferred Exchange into a Delaware Statutory Trust to be able to preserve all of your equity going forward. Sometimes you don't even have to get as big of a return. I'm not saying you can't, but you don't have to, because I mean, if you think about it, if you get an 8% return on 75% of your money because you had to pay tax, it's the same as getting a 6% return on 100% of your money, right? So,
right.
And I'm, again, I'm not saying that you can't get the better returns too. So you have to look at the underlying asset class. Don't just say, oh, it's a Delaware Statutory Trust, I'll do it. You still have to do the same thing you would do in any deal. You need to vet the manager. Mm-hmm. You need to vet the underlying deal and the investment thesis. Does this asset class make sense? Does this market make sense? Does this team look like they have the competency and the ethics that I feel comfortable putting my capital under their stewardship? And if the answers to those things are yes, then you've got something that's interesting to take a look at. And I would definitely put my trust in that before I would trust it to Wall Street. That's me.
Absolutely.
Now, I'm not saying everybody watching this feels that way, but if you've made it this far and you want to learn more, Paul, you put together a report for us on the radio show. And so we're going to make that available to everybody here on the YouTube channel. And it's called How to Create Massive Wealth Through a 1031 Exchange and Delaware Statutory Trust. It's a good looking report. If I was better at operating Zoom, I would show it to everybody, but it's 19 pages, so it's not overwhelming, and there's some pictures, but it's good, meaty content. So thank you for putting that together. If you're interested in getting that, just send an email to DST, like Delaware Statutory Trust, at realestateguysradio.com. We'll put the information in the show notes below. And then if you're interested in talking to Paul, there's a contact link down there. You can go to his contact page at the Real Estate Guys Radio website. And I'm sure he or someone on his team would be happy to talk to you about what they're doing. But it's a powerful vehicle. If you're out there and you're sitting on a bunch of equity and you're thinking you're not at the end of real estate, but you're at the end of your direct real estate ownership, and you want to preserve that in an exchange, Delaware Statutory Trust could be a great tool. So Paul, any closing comments before we wrap this thing up?
No, I just want to reemphasize what you said, though. You still have to look at the underlying asset. You still have to look at the operator. You might even want to go ahead and drop a few $100 to go fly out there and see it in person. The very minimum you'd want to do would be to do a very Google Earth, up and down the streets. You'd want to do a 1-3-5 analysis where you're looking at everything going on in a 1, 3, and 5 mile radius around it. You still have to do all that because this is your hard-earned capital. But if you're satisfied with all that, you're satisfied with the operator, sometimes you can even find a no-load one that has no broker-dealer fees. We're aware of those. They're hard to find, but they're out there. You should definitely consider this as an option. I'm potentially going to be doing a 1031 exchange myself soon, and I'm really excited to have this vehicle.
Yeah, no, we're very excited to bring it to people. Hope you all enjoyed it. Paul, thanks so much for your time, your contribution, the report. Again, if you're interested in the report, DST at realestateguysradio.com, and we'll get it right out to you. Thanks so much. Before you go, 3 things. Number 1, subscribe. When you subscribe, you build up our subscription base, and that helps us reach more people. But even more important, it helps us attract great guests and subject matter experts to share their ideas and information with you. Number 2, click that notification bell to make sure that when we do post a new video on this hot topic, you're notified right away. And number 3, share. Please share this information with friends. Help them get on board this bus. Help them protect and preserve their wealth to take advantage of what's going on in the world today. All right, thanks so much, and we'll see you in the next video.